So what if we want to find out the dollar sales? So dollar sales, you remember our formula that profit is equal to CM ratio multiplied by the sales minus fixed cost. In that case, this sales is for unknown sales. How much in number of sales dollars, like how much we sell in number of dollars in order to achieve break even, right? So let's solve for this S here. So you put the value here. We know that the 40% is the contribution margin ratio, 80,000 is our fixed cost. We just solve for S, and S is 200,000. So how we can explain this? If the RBC sells at least sales of $200,000, then at the end its profit would be zero, and that profit would be break-even profit. Okay, now let's use the formula method to find out the dollar sales of the break-even. How this formula came from, because we already know that in our previous slides that the target sales would be profit plus fixed cost divided by CM ratio, or in percentage, right? In that case our profit is equal to 0, so you just put 0 here. That becomes fixed cost divided by CM in percentage, right? So this is the same formula. So here you just apply this, you can find out 80,000 is our fixed cost, 40% is our CM ratio, and it's the same dollar amount. So it's up to you whichever method you want to use, or you can easily grasp. So here come a quick check. I just want you to pause the video. It's the same question that we already discussed in our previous slides. So in this case, we just want to find out the break-even dollar sales. Okay, let's do that. So what is the formula for break-even dollar sales? So we know that sales break-even is equal to fixed cost divided by CM in ratio, right? We know that the fixed cost is equal to 1300, but our CM ratio, how we can find out CM ratio? What is the CM? CM is 1.49 minus 0.36 divided by CM divided by sales. Sales is 1.49. It is 0.7583, which means 75.83%. When you write it down, 0.7583, the answer would be 1714.36. The closest one would be here, B, right? So B is the correct answer. And now we are starting learning objective 7, which is compute the margin of safety and explain its significance. So let's explore that. So the margin of safety, it helps the management to assess how far above or below the break-even point the company is currently operating. So to calculate it, what is the formula? The margin of safety would be total sales minus break-even sales. So the margin of safety in dollars is the excess budgeted sales over the break-even, right? So let's calculate the margin of safety for RBC company. So RBC is selling right now 500 units, and its current contribution margin income statement is like this. So here we know that the break-even analysis returned 400 units and its profit is 0 here. So we know that the actual sales or budgeted sales is 250,000 and break-even sale is 200,000. So in that case, above 50,000 we are safe from margin from break-even margin, right? So how much we are safe? Our sales are above 50,000 from the break-even point. So this 50,000 is called margin of safety. This is in terms of dollar. If you want to calculate in terms of units, so how much? So just budgeted sales units minus 400 is the units. Answer is 100. In terms of units, we are above 100 units.